Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for new longer episodes every Tuesday and our shorter ones every Friday. Welcome to this week's episode of the Prime Property Finance Podcast. I'm super excited to introduce this week's guest, which is Roger Morris from Chetwood Bank. And their two brands are ModaMortgages and CHL, who work predominantly in the specialist finance space. Roger was a sales director at One Savings Bank, which was Kent Reliance and Precise for a long time. And he revolutionized some of the products there, such as the buy to let refurb product. And he's got a massive knowledge within the HMO space. And he's always supporting landlords and mortgage brokers to make sure that they're giving the best advice that they possibly can. So without further ado, really excited for this episode. Let's get into it with Roger. Roger, great to have you on the show, and really thank you for giving up your time, because I know you're a very busy man and a big expert in the industry. So welcome. How are you?
I'm really good, Gareth, and I'm looking forward to this. It's been a little while since the two of us have caught up. So yeah, everything's good in my world, and certainly in the world of buy-to-let.
Yeah, it's a very busy market, as it is always. There's plenty of challenges thrown at us, and it's this year to test us, of course. And our job is to try and keep it going, really, and keep coming up with new ideas and presenting solutions to landlords and investors, I guess.
Yeah, absolutely. I've been a landlord, Gareth, for over 30 years, and the industry has just transformed itself in so many different ways, with so many different things positively affecting the industry. Yes, there's challenges, but I can't remember a better time now to either start buying or building on portfolios, Gareth, for sure, because the rental demand, the reports, is it 12 families go for every property? But my experience in Birmingham, last property we put up 3 weeks ago, had 39 families. So it's certainly a great time to be in buy-to-let, but Gareth, definitely using a mortgage advisor. Even with more my experience, I certainly would always use a mortgage advisor.
Yeah, I think the point you touched on there is a really important one, and this is probably an unintended consequence of the way that the government has probably been quite harsh on landlords with all the changes and increases in regulations, which some of them were needed, of course. But the consequence of that is that landlords are leaving the industry, and the consequence for tenants, or the people they were trying to protect with all of this stuff, is now it's driving up rents, unfortunately, because simple economics is supply and demand, and like you said, 39 people competing for the same property. Ultimately landlords will just put the rents up to support the extra regulation and the increase in interest rates. So it's a challenging market for renters, isn't it?
Yeah, it is. When we do talk a lot about a lot of landlords leaving the marketplace, but I don't think that's necessarily driven in the main by regulation. What I would say is when George Osborne announced the interest relief changes, in other words, being able to offset our mortgage payments in our buy-to-lets in June 2015, and the only way to do that is either being a basic rate taxpayer, which means that your combined gross rent and gross salary didn't exceed 50,000, that they ultimately had to own them in a limited company. And what we're now seeing is those landlords in the recent new rate environment, Gareth, where interest rates were sort of around the 6% mark, if you were not able to offset interest as an allowable expense when managing your business, your buy-to-let portfolio, and then with increased service charges, which we've seen a lot in flats, a lot of landlords have been exiting for that reason. So I think there's a lot have left the industry just because the math didn't add up. But also I think there's been a significant amount of landlords entering the industry, and that's been done with cash purchases, Gareth. And I actually think as rates drop, we will start to see more mortgage properties come through. But I just think there's a bit of a correction, and I think we will then see a big surge in new purchases, and certainly keep you busy, Gareth.
Well, I think there's a few things there. I think the first of all is also there's a natural progression in people coming, entering and leaving any market, isn't there? And so some things spur people on to make those changes, and landlords who've historically had very little compliance to do and have had it good in inverted commas from a tax perspective, when that environment changed, that was probably the thing that they're just tired of being a landlord, and they're ready to retire. And so that maybe they're exiting for that reason, which are not the reasons that some people are suggesting. And also for new entrants to the market, they are coming in with eyes wide open, aren't they? You know, they know what's in front of them. They know the regulation is there. They know what the standards need to be. And so they're coming into it, but they're hungry and they want to build a portfolio. And I think that I saw stats that there's record numbers of limited companies being formed for the purpose of being of investing in property. It was interesting stats that actually a lot of those companies are formed 12 and there's no activity in them for the first 12 months. So people are setting them up with a plan, but actually taking a bit of time from the point that they've planned to do it to actually executing a purchase, which is interesting. I don't know what the reason is behind that. Maybe just struggling to find an ideal property. But yeah, there's lots of exciting stuff. And I know we'll touch a little bit about the personal versus limited company stuff maybe in a bit. But yeah, there's lots going on.
Yeah, what I would say though on those key points is, if I look at when I started buying property in the mid-90s to today, and we look at like landlords leaving, you've got to think that reason isn't because of profitability. And I'll sort of think about this. In the last 3 years, rents have gone up by 42%. So imagine your own income had gone up 42%. You most likely wouldn't be leaving your employer or your particular role or your job. So rents have gone up substantially in a short period of time. And letting agents, when properties are coming up for renewal again, what's happening with those properties is letting agents go in, oh, you can now achieve this on this property. And I know with 3 of our ones in Birmingham, we actually go, oh, I'm not so sure about that, because they want us to rent the property out way above what we're thinking. That's just too expensive. So we're having to sort of say, let's not do it for as much as that. And then the cost of interest is actually reducing. You know, we're expected to have 2 or 3 more interest rate drops over the next sort of like few months. So it's kind of, I just think we've got that perfect storm that those that are in it are set to make an awful lot more money. And there is that point as you get older, Gareth, because I've just sold off, I've only got 1 more to go, my entire portfolio in the northeast, to just concentrate. Now I'm living in Birmingham because I'd like to have less boilers to go wrong as I get that little bit older. I'm certainly not out to buy to let, but there is that transient journey in a landlord cycle. And this is where you might pass, if I was living up there now, I would have passed those properties on to my children, but I'm not living up there. So you do have to evolve. Again, I keep coming back to, Gareth, the most important thing in a landlord's world is a mortgage broker like you, somebody that really understands the marketplace. And you need that sense check, that validation of, Gareth, this is what I want to do. What's your view? Even if we just agree the views, it's that collective value. And the one thing I do find, there isn't that many good brokers with your years of experience and your life experience layered over with it. And these are all valuable.
You touch on a point that you raised right at the beginning there around, and this is so important. I'm being an investor myself. I understand this stuff. And the point being that we see it all the time. Clients come to us and go, my rents could be, I can get £1,000 a month for this 3-bed mid-terrace. And I'm saying somebody may be getting £1,000 a month for that property right now, but that is, you do not want to be charging that. And you don't even want to be trying to get it, because you'll have people trying to get it. People will sign up, and then after 3 months, you're going to have a problem because they realize that they can't afford it. And it's just the percentage of their salary, and they've got no disposable income. They're not going to maintain the property at all. They won't have the heating on, and that's going to cause you more long-term problems than actually having at a decent rent, which is a fair rent. And so squeezing, and this is the profitability piece over, it's a short-term view, trying to squeeze it for as much rent as you can now over tenant changeover, maintenance of the property, etc., which from an investor's point of view is the long-term stuff, because if you've got to get that tenant out, they can't pay, and then you've got to take them to court, and you've got voids, you've got mortgages and things that you've got to pay, and court fees, and etc. Actually, just having it in there at a decent rent, which is fair, and having a good tenant who values that, and they're going to be in there for a number of years, is going to be far more profitable for you than getting the absolute top rent that you can get for that property. So it's those considerations, isn't it, that people have to think about a little bit more than just the single factor in the whole jigsaw that is the portfolio.
I think you're spot on with that, and I think where the Renters' Rights Bill is focusing on is bad behaviour of London landlords. The one thing I love about Wales, like the northeast of England and the Midlands, is landlords feel social responsibility. The tenants, they want fair value. Is, if I charge you a fair rent, will you pay me that? Is it affordable for your family? You don't want children sort of moved out of schools and upset the curriculum because they suddenly put the rents are too unaffordable. But in London, Gareth, the landlords that you see down there, they would want to exploit every bit and become litigious and take families to court. And that's where I think the negativity is coming from. I just believe that the bad practices that I hear in the consultation process just come from that minority, but are London-based, and it's just awful. So the best advice is what you're saying, is have a good quality property, well-maintained, at an affordable price that a family can have, and they'll be in there for years, and it becomes a really good business model on that basis.
Yeah, absolutely. So the second part you touched on previously then was maybe things that listeners will be very interested in is around interest rates. So where do you see interest rates going at the moment now and over the rest of the year, and a little bit more maybe about the wider market?
So the funny thing is, for the first time ever, we've now got interest rates are less relevant to the cost of borrowing. So you might be listening to this going, Rog, what do you mean? Interest rates aren't there to the cost of borrowing. We will anticipate maybe 3 more cuts in interest rates over the next 12 months. However, the economists are predicting a very gloomy autumn this year, because Rachel Reeves won't have enough money, so taxes are going to have to be raised, and this might be causing more unemployment, employers having to lay off people, and people struggling to pay bills because of the increased taxes in whatever the governments decide that they have to do. So with a non-political point, there is that concern. There is the geopolitical issue of what's now happening around the world will increase inflation with the cost of oil prices and tariffs and charges. So as much as you think what is happening in America or what's happening in the Middle East, it does affect us in our homes in Wales and England. And it's these things that we have to rely on. When I look at swap rates at the moment, swap rates are so volatile. I can see them move 20 basis points in one day. So that's the equivalent to a 0.25% reduction of the Bank of England. So it's quite possible when the Bank of England drop the next base rate cut, we might see rates actually increase. And this is where the madness is coming from. So we don't anticipate the interest rate environment dropping much more than 0.5% for the long term, which is why we've got so much volatility in money. So I think what represents where people can see rates dropping over the next 2 years, a good 5-year fix, Gareth, at this moment with the economic uncertainty, feels to me as if that might be the right thing to go for, because locking in stability now isn't a bad thing. I mean, I'm not advising on this, but this is where you as a good advisor would come in and say, but I would look in my portfolio. If I was looking for new rates now, I'd be going 5-year, not 2-year, because there's just so much uncertainty out there.
And where do you see kind of you mentioned where do you see a good 5-year fixed rate maybe for a landlord or a limited company buy to let? What do you see? What would you see that on your horizon as like, yeah, I'll jump on that?
I just think roughly where rates are now are where rates are. I really do. As much as we can see interest rates dropping, the headwinds look like those rates might go up. So I think again, as a personal, as Roger Morris, the landlord, speaking to Gareth Morgan, I would be saying that I think where we are with rates at the moment are there or thereabouts for that long-term stability. So I wouldn't be holding off from speaking to you now to say, oh, I'm going to wait a few months to see where the rates go, because I just think there's that much uncertainty at the moment. If you're happy with the rate, the maths fits, you can make profit. And then when it comes to a limited company, you really want to have a good conversation with your accountant about the 5 and 7% fees, because in a limited company, you can offset the interest on that 5 or 7% fee being added to the mortgage. You could accelerate your payments because your rate will be cheaper than a lower lender fee product, and you could accelerate your payments. So within 5 years, you've paid back that 7% fee from the increased extra cash flow. And then also with a good accountant, you're able to, in 5 years' time, Gareth, be able to offset that 5 or 7% fee within the savings that you'll make on the tax that your profit, your base from the company. So it's about really understanding those higher fees ultimately potentially could lead to a lower net profit or higher net income position. So it's about understanding those fees, different in personal names. In personal names, you can't offset them like you can a limited company. So I would really try and understand what those higher fees mean to your taxable profit.
Yeah.
And really think about those fixed rates.
Yeah, thank you, Roger. There's a lot in there. So I'll just kind of head back to the beginning where we talked about the fees and interest rates coming down and things. I think that's something that I know Mark has just done recorded a podcast for how Bank of England and swap rates and how they interchange with each other. And I've also just done one on, whether you should go for a 2-year or 5-year or a variable and things, just to understand the important factors and the considerations when making that decision, because those are common questions that we get asked. And then you talked about the point of I had an email exchange with a client who's got about 5 or 6 properties on a portfolio type product, and the rates are coming down. He's watching to see what's happening, and I think we've had about 2 or 3 exchanges over the last 6 to 9 months. And every time I've gone back to him, the rates are the same. The rates are the same. So no matter what has happened, the rates are pretty much like, so that echoes your point that because it's a limited company and it's a different funding line to the Bank of England. And so whether the Bank of England rate comes down on limited company, investment type stuff, the rates are the same regardless. And so now you're best off just getting on with it. If there's savings to be made as well. So for every month that goes by that he doesn't make the change, he's losing money. So I think there is that point. And then you started talking about then the differences between personal and limited company, which obviously is a huge topic. But yeah, very much so. And again, another conversation that we have all the time is around, oh, I don't want to pay that fee. Okay, well, understand the way that this fee is structured. Most lenders, the way they structure their products are, we'll offer you this rate with 0 fee, or that rate's a bit high. Well, yeah, but what we'll do is we'll offer you a lower rate, but with a higher fee. But actually, when you work out the total cost over the term, they work out exactly the same. So it's just a way that you can use if you need the cash flow, then you can take the lower interest rate, but that also goes towards the lower stress test from an affordability calculation, which means you can actually borrow more against the affordability side based on the rental that you receive on that property. So there's a number of reasons why you've got those higher rates, but also, like you said, there's possibly a tax advantage of taking those higher rates, the higher arrangement fees as well.
What I would say is if somebody said to me where they didn't want to pay a 7% or a 5% fee, the question is why? Are they just looking at it in isolation? And it is a big number, Gareth, it is a big number, but when people, I was with a friend of mine the other day, and they're buying a new property, and they were going to buy it. They were deciding we're going to buy it in personal or limited. And let's just say, make it simple. The monthly payment in personal, Gareth, was 500 quid a month, and the monthly payment in limited was, say, £530 a month. They see 500 is a lower number than 530. So they think £500 a month means it's a cheaper and better deal than 530. And I say, how do you come to that decision? Because the 500 is an expense to the business. It's a payment you have to make, but is it also a deduction on your tax bill? But the 530 guaranteed is a deduction on your tax bill. So you can offset 100% of the 530 and just 20% of the 500. So therefore, limited company ownership mathematically will always be better. When you look at fees, what you want to do is to sit and work out what is the net income after tax on a 5-year fixed with a 7% fee, and what is the net income after tax with no fee? Because if you aren't working it out, because that 7% will reduce your tax bill. So would you be quite happy paying less tax to pay a bigger lender fee to actually earn more income? And what you have to do is you've got to look at it all on a spreadsheet of a tax return. And without giving tax advice on here, a good tax advisor would look at that 7% fee as a positive, not as a negative. And I think what we've got to do now is look at the cost of finance, how it's deducted, how it means we pay less tax, and how much more tax we would pay if we didn't have that fee. So it's really debating it through. The big serial investors that I deal with who have lots of property, Gareth, they absolutely love the big fees. It seems to be the investors who only have small amount of properties have a different view of it. So I think it's about, you've got to understand, what does that fee actually do for me?
Yeah, definitely. And I think that just goes to the point that you have to be engaging with the professionals. It's not as straightforward as going, yep, that's the rate I want. And there's so many other things to consider, aren't there? And, the 5-year thing, when you're making a decision for a new deal, are you sweating that asset? Are you looking to buy more property? Do you need to make any changes in terms of trying to increase the EPC rating to future-proof it? So because if you lock in for 5 years now, are there penalties to come out and various things, because we don't know necessarily where the government, although they've said where that may be in terms of EPC, and there's a good guide, it's still not been confirmed yet. So there's lots of considerations on there when, it's not just what's the cheapest rate. And I think that's the important piece that a lot of people miss.
I think when we look at the EPCs, Gareth, I'm very, very opinionated on this. So if you've got 100 grand Victorian 2-bed property in the Rondas, right? And I'll give you the perfect example of a 100 grand property in Hartlepool, Victorian property. If you've currently got that as a D now, and you've done the loft insulation, combi boiler, double glazing, yes, everyone quotes the energy light bulbs. To get that to a C, the big problem you've got to do is you've got to brick up all the air bricks, which these properties are not designed to do. The information on your EPC report of what it costs to convert is absolutely 100% inaccurate. And it comes from the information and costs come from 2002, from when we started the HIPs, the home information packs. So it's so wildly inaccurate. To move a Victorian property from a D to a C at this moment in time with the current rules is £35,000. And it's a capital expense, so you can't offset that against your tax return. And it's believed through the Building Back Britain report that you will actually devalue your house because you're going to take away all those Victorian qualities. So if I had what the report said, which is what changed the last government, if your house is worth 162 grand or less and it's Victorian, do not do any work to it. You're better off selling it, taking out the cash you can, sell it to a first-time buyer, and then reinvest in a new build, because then you won't have that huge maintenance cost. So we need the government to come back. We need the SAP 11, which is how you calculate EPC reports, to actually be updated. But also, more importantly, the cost of the works that the EPC states is so out of date, it's breathtaking. And I think the government will be in a liable position with that data at the moment. So yes, it would be great to improve these properties, but the cost to these families, because they will have to be moved out because it can take 3 months, and then the landlord's going to whop up the rent, Gareth. Will they see the benefits of it? They won't. And a lot of landlords, like I have in the Northeast, that's the reason I've sold mine, is the writing's on the wall. The government could impose this. Let's just get out now. And my strategy is buying new build properties. But that's only because I'm at an age in life, Gareth, I don't want any more hassle.
But again, this is another one of those unintended consequences of this policy, because like yourself, now you're selling a property which is, in the government's eyes, is a problem property because it's got a low EPC rating, and you're just passing that on to a first-time buyer because that's the only property that they're going to buy, and so they're going to have to deal with that, you know, the low rating and the cost of increasing it. Not that the same level of compliance is needed on a residential as it is on a buy-to-let. However, you know, landlords, and you're not the first person who's told me that, a lot of people are now moving into new builds, and that's taking up all of the new build demand, which is reducing the options for those new builds for first-time buyers. So it's definitely it's challenging. It's challenging, and because there's no, like you said, the changes have been in the EPC calculations have been there since 2002. You know, you've seen prices going up since 2022. You know, in terms of costs of labour, materials, etc., have absolutely gone through the roof. So to have prices based on 2002 is just way off the mark, isn't it?
The biggest thing, if you said to me, you're going to think this is mad, but I do think you'll go with it. The biggest thing that's driving tenant behaviour right now, Gareth, is Instagram. And you're going, Instagram? What people are saying to me, I did a bit of a survey with my tenants. The modern tenant today could be 30-year-old, 32. They work from home. They're going to get an electric car because it's kind of, well, we know that they're going to become a thing. So they want car parking with sockets already there in place. They want a garden that's fenced off. So when I'm buying a property now, I have a 6-foot fence all the way around so that a little dog can't disappear underneath, and the children are locked in and safe. So if you're working at home, you've got little ones, Gareth, they're in the garden, the gate's padlocked, you know no one's going to pinch them, so you mentally relax. And then when I showed the last 2 families round they weren't new builds now, they're about 2-year-old, they're on taking selfies for Instagram, and they're going, we love this is going to be our home. And if you ask them follow up afterwards, they want to be able to show the world they don't necessarily want to own it, but they want it to be aspirational with nice kitchen and nicely laid out and clean lines. So there is a big change of behaviour driven by social media of I'm living the dream and I've got a lovely home.
And people will pay top rent for those properties as well, won't they?
Yeah, a lot more than a Victorian. So comparative to a Victorian house, roughly of the same value, I might get 200 or 300 quid more. And is it when they said, if you ask tenants, would they like to pay less in energy bills? Well, anyone's going to say yes. But would you pay comparatively higher for those properties? But then there is that social order of where if your grandparents and parents are near you in a community that you love, which is in a Victorian estate, you're not forced to, but you want to live near your family. So sometimes it's dictated by location. Well, I just think as a business, Gareth, if you've got as a business, you're about to be asked to spend £35,000 on a property worth 100, you're going to make a business decision to go, it's not what to do. So we just got to wait for Ed Miliband's now in a consultation phase. But the way that this particular government's doing it with the Renters' Rights Bill and the EPC changes, you could see the biggest significant impact to the cost of housing, and you're going to drive rent way higher than where they are now. And that I don't think was ever Labour's intention to do that. But you've got to understand that these are businesses, and I think we are estimated to have 5 million more people enter the UK between now and 2030, Gareth. 5 million, it's a lot of people.
And I think the target on building new homes is 300,000 new homes a year. And we haven't been building 200,000 new homes a year. So when you look at those, stats, and then you think, right, well, actually, how do we increase by 50% what we're building when we're not already delivering that? Plus, we've lost so much labour after Brexit and after COVID, when a lot of labour went back to the mother countries effectively, and they didn't come back. The cost of labour now, the cost of materials, the shortage of supply, and like you said, with the geopolitical things going on, that's potentially going to get worse. I just don't see how we're gonna keep building these properties. So obviously the demand is for these properties going to increase, which is going to put rents through the roof. What do you see? What areas? How do we fix this problem, I guess?
Well, the first bit was when, again, and I'm not political, quite the opposite, but when they sat down, the Labour government, the new government, our government, to build 300,000 homes. So if you and me, we're going to build a wall at home, and let's just say there's only one builder's merchant near us, right? So I'm going to come and build a lovely wall in your back garden, right? We got the approval. The wife says we're in, we're happy. And I said, I'm going to come Saturday and we need 1,000 bricks. And you go to your, there's only one, there's your local builder's merchant. And I said, Gareth, I've only got 500 bricks. There's no more bricks. That's all I can give you. You suddenly have to come back to me, right, Roger, we can't build a wall. We have to build a dwarf wall. Well, that was the problem that the government had, is when they went out to the builders, and they also went out to what is in effect the wholesale market for supply, we don't have enough bricks available for us to be able to build that many houses. We can only get half the amount of bricks needed over the next 5 years to be able to build 150 houses. For us to go to 300, we'd have to invest in brick manufacturing substantially higher than where we are now. So it will be in the next term of the parliament before the likelihood of that to happen. But if you speak to the house builders, what they're terrified is if they suddenly increase production to 300,000 and there was an economic recession, they would be left with products that can't sell. And that's where the builders would go, could collapse. So I can't imagine a house builder wanting to increase production more than about 5% per year. So if you speak to Barrett's and Taylor Wimpey and Persimmon, they don't want to build. And the more they build, it devalues their assets. So I think we're in a bit of a negative situation. And if we're now starting to condemn Victorian houses, which were never designed to breathe, and also if you look at the Renters' Rights Bill, AWAB's law, so AWAB's law is about damp and mould. Now, if you have ever put double glazing in with Victorian property, your tenants will have at some point complained about damp and mould. And that's because the house becomes a lot more sealed up. So if you tell the tenants, open the window and it'll go, I'm not opening the window because it's the cost of heating. So you've got some litigation issues of making the property C-rated, and you've got to put in industrial ventilation in the property, which is noisy as anything. And you've got to make sure the tenant can't switch off that ventilation. So there's a lot of unseen consequences that are going to come from this legislation. However, what I would say is I can't think of a better time for buy-to-let, but I do think new build is the answer. But are we going to then see legislation which stops landlords buying too many of the new builds to give first-time buyers a chance? Again, it leads the question.
Yeah, and that does make sense, and you can see why they would do that. And again, then you're going back to trying to find suitable second-hand market properties which meet the bill without having to spend a lot of money on, air circulation, like you said, that isn't too noisy, that isn't costing a fortune, that so the tenants have to keep the windows open. But the damp and mold thing is a big issue I've seen in the past, and it's a frustration of mine because people want, we have to open our windows at home to get airflow because condensation is purely caused by lack of airflow, isn't it? And when, people are the biggest creators of moisture in a building. It's actually people. So when you breathe, you're getting rid of. So when you're sleeping in a room that hasn't got a window open, it's got no ventilation, and there's two people in that room, it creates a lot of condensation, which is why sometimes you wake up in the morning and there's condensation. So the first thing you do is open the window. And if you don't do that process and that there's no airflow, that causes damp, and that left over time. And the problem that I have with this law and is that, and I get that there will be circumstances where landlords have got poor properties. I get that totally. But tenants have to take responsibility as well. And I think some of these changes are too in favour of the tenants to not take action that they need to maintain the standards themselves. So, yeah, I'll probably park that now, otherwise I'll get on my soapbox about it. But yeah, absolutely. There's so many of these little things that people have to consider, isn't it? So just going back then, so you think with the extra people coming into the market, so the extra people coming into the UK, I think you said about 5 million or so expected by 2030, we're not building enough properties. So do you see then an increase in the market for HMOs? Do you think that would be a market that will become more popular, although it's even harder now to get planning for it? So I know you've got a lot of experience within the HMO sector.
Yeah, Gareth, I think you said the first thing is planning. It's so refreshing to hear. And again, this defines you and your expertise, because most mortgage advisors not even aware of what's planning got to do with it. So if you think of Birmingham or Wales, either or, because in Wales, you can't just create a HMO anymore. You've got to get change of use. So what does that mean? So the definition of a HMO is 3 people living in a property comprising of more than one family unit. So 3 students is a really easy one, and sharing one or more facility. So if you've got a property and you put a family in it, there's no issue with that. There's no restriction. Everywhere in the UK is happy with that. But the moment you try and put 3 students in, you've got to get a planning application to move that property from a C3 to a C4. And in Birmingham, if you were to take a 2-bedroomed new build flat and put 3 students in, it would be illegal because you haven't got planning. So the first thing you've got to check, and a good letting agent will help you on this, if I buy that property and I want to put students in or 4 professional sharers, can I legally do that? So always or speak to the planning department, but not the licensing department. So in England in particular, I would always advocate, we've seen this again, not quoting Birmingham, but Birmingham's a big city for HMOs. And they'll ring the licensing department saying, right, I'm buying this Victorian house, I'm going to turn it into a 5-bed HMO. Will I get a license? And the licensing department said, absolutely, Mr. Morgan, you will get a license, no problem at all. We'll send you the forms out, send it in, send us money, where we go. But if you were to ring next door in Birmingham's planning department saying, I'm buying this Victorian property, it's not a HMO now, will I get planning change of use? And they'll go, absolutely not, Mr. Morgan. Don't even apply because you won't get it. Well, hang on, I've just spoken to the licensing department. They'll still give you a license. Oh, you'll get a license, but it'd be illegal to put anybody in it. And that's the madness of, which is unfair for landlords. But when we look at HMOs, what we're seeing now is the two brands that I represent is ModaMortgages and CHL Mortgages. Now, CHL particular talk about building what we call hybrid HMOs. So again, I'm going to pick on Birmingham just because there's some really good examples here. So where what someone's got is they've bought a building and they've got planning change of use, or the building already comes with that change of use. And they used to have students in. And what they've done is when the students came at the end of the semester, they refurbished the property and put ensuite in every bedroom and made the decor and the quality so much higher. And if the rooms were big enough, Gareth, they'd put mini kitchens in, but make it really good quality, landscape the garden, make the car park right. And what they would then do is market those properties on Airbnb as serviced accommodation. So serviced accommodation, high-end executive HMOs, and the rent returns are massive. So again, what we're seeing now is landlords become more innovative. And without a doubt, there's going to be more demand for HMOs because of the cost of living. And do you know what? If your housemates are relatively all right and you're not on a big income, then HMO is sharing the expenses of running a household. It's far better to maybe rent a room, have access to a kitchen and a garden, than maybe renting a 1-bedroom flat with no garden and it's a bit hemmed in. So I do see HMOs changing dramatically.
Yeah, absolutely. And I know that, and this is a conversation that we have all the time. And again, because of the planning in Wales specifically, which, we work and invest in Wales, but we've got clients all over the UK, and it's a different type of conversation where in some areas in the UK, you can convert a 3-bed house into a 6-bed HMO without the need for planning permission, and that's fine.
Yeah.
But like you said, in other areas, so then those areas will need, within Article 4, within those areas, you will need planning permission. But in effect, in Wales, the whole of Wales, then you will need planning permission to change of use. And so as an example, if you want to turn that 3-bed terraced house into a 6-bed HMO, for instance, you need to go through one planning application, and you didn't need to win that application. And then because the end of the change of use, you will then need to input, you have to go through building control. In Wales, you need to input a sprinkler system into the property. And obviously then the thermal upgrades, the noise in between rooms. So there's a huge amount on the cost of conversion then. And so that's a challenge that has to be worth it financially in terms of the cost of those conversions. So it's not as straightforward as it used to be in terms of just put an extra toilet in or an extra bathroom in and away you go. So there is a lot of misinformation, but also a lot of people need to understand the local rules in the area, because you might be living in Wales and investing in England, or vice versa, or you might be living in Birmingham and investing in the Northeast, and you might be able to. So you really need your finger on the pulse, and it's finding people who are currently investing in that type of property, in that type of location, to see what they are doing and getting advice from the right people. So like the right departments in the local authority, because I chuckled when you said about I've spoken to licensing department, and I have that all the time. I've spoken to the council. They said, right, okay, you've spoken to licensing. Yeah, have you spoken to planning as well? Oh, no. Yeah, so there's two phone calls you need to make when you speak to them. So yeah, it's a huge tip. So thank you for that. So I guess it's a changing landscape, and like you said, sharing the cost of living when the cost of living crisis is, and inflation and rents are driving up, I think, and it's even more challenging. I think, more and more people, and again, it's the Instagram lifestyle. If there's a high-end HMO, they really do tend, people like a nice place to live, and they're prepared, because younger people now are more supported and encouraged to live this sort of laptop lifestyle and move about to, they're a lot more transient about where they live in and traveling, etc. Actually, not buying a property at a young age is seen as is okay. Whereas maybe older generations were, leave school, go to university, get a job, buy a house, have a family, and that kind of dynamic has changed massively now. And I think that people, because of the people moving around so much and traveling, actually the more demand for HMOs, because they can come in, if they like a location, great, they'll stay and stay a bit longer. If they don't, they'll move on to the next city or the next job, and that gives them the opportunity to keep moving around until they find somewhere that they want to live. So yeah, interesting times ahead in that space.
Yes.
One last area, because I'm conscious of time, one last area I'd like to talk about is, obviously we touched on it earlier on, is the personal conversation that we have again a lot, is the personally owned buy-to-let properties versus limited companies. So this is more for existing landlords, a conversation which has been doing the rounds a fair bit now that these changes have come in from the government, and whether under Section 24, so whether you maintain your properties in a personal name or whether you look to change that portfolio, either incorporate it into a limited company. I know there's been a lot of speculation. There's been a lot of media. There's some companies that have been selling this service of incorporating, and there's been some issues around that. So do you want to share your thoughts on whether that is a good move to make, and some of the challenges that, or frequently asked questions that people would have around incorporating?
So I'll make it really simple. First of all, I'm not a tax advisor, so I'll just give you a factual explanation. Gareth would happily come back on here with the tax advisor I do lots of presentations with to kind of make this a bit simpler. The vast majority of people would be unable to move a portfolio from personal to limited without paying capital gains and stamp duty. However, there is the Ramsey ruling, which is incorporation tax relief 1 section 162. It's the right of an individual or a partnership, either or, that has a trading business for managing property that is not classed as passive income. So in simple terms, if you qualify and meet the rules, but it's got to be a full-time property-led business. It can't be part-time, can't be using letting agents. And the Ramsey ruling had 5 properties, but you've got to have servicing in there. Again, this isn't anyone that can meet this. It's very few. So it's individual or a partnership. There isn't a time frame of how long that partnership and the trading business has been happening. But as long as it's not passive holding of property, then you can investigate the ability to move that portfolio into a limited company and transfer your capital gains liability. So you're not having to pay it, it's transferred. Stamp duty is separate. That only qualifies to partnerships. And it's partnerships that have run a partnership for over 3 years who are transferring into a limited company can, if they meet the rules, potentially not have to pay any stamp duty at all, because they're just transferring. It's called the sum of low proportions. There is a piece of legislation in 2015 that allows that, and the two are not connected necessarily. But you can have a couple who run a property-led property business. that have been going for more than 3 years. It's the full-time job. They meet all the rules, can potentially, with the right tax advice, transfer from personal into limited and not have any tax due at the time, but the liability is transferred into the shares. So the capital gains at some point will have to be paid, but that might be 40 years from now.
Yeah, thanks for that, Roger. Really simple explanation. And I think one of the key things where people are starting to get caught up with some of this is that they may have a portfolio of 10 properties owned between a couple in a partnership setup and for more than 3 years, but they might have they might have an letting agent that runs the portfolio. They have a maintenance team in place. So actually, like you said, it's more of a passive income. And whilst property is never passive, there's a lot of stuff that goes on behind the scenes. It's the amount of hours that you spend during a working week on that portfolio, managing that portfolio. And so if you are running around managing the property and you are doing all of the maintenance and is that your main source of income, then you're more likely to meet that criteria. So now that we're a bit clearer on the definition of it, what are some of the challenges? I know, obviously, if you were, let's say you had a portfolio of 30 properties currently in your personal name, and you had a couple unencumbered, but you also had a number of them, or the majority of them, on mortgages with different mortgage end dates. How would the need of incorporating that portfolio all on the same day to meet the definition of the incorporation, how would you see that, the management of that?
That then becomes the biggest liability, and advisors get that busy involved in everyone else's. I've seen it where large portfolios have incorporated and the biggest penalties being ERCs, early repayment charges, and the advisors got themselves into a litigation with the landlord because they've had their head that stuck into nosing about in capital gains and stamp duty, which is nothing to do with the mortgage advisor. That's not your area. They forgot about early repayment charges, and it's 5%. It's nearly the same as stamp duty.
Significant, yeah.
It's significant. So this is again why you need really good strategic advice, a really good broker. There is some lenders potentially that will happily novate the debt across, but the problem is there's been that much bad tax advice they haven't really wanted to do it. So my advice: get a really good tax advisor, understand if you're liable to do this, and then plan in advance where what you're trying to get is a way that you can get the lowest point of early repayment. But it might be where you might end up 6 months on SVR, which is very expensive. So you've got to do a lot of math. Is this all worth it? Is this really worth the end result? And that's where things like early repayment charges are going on to SVR become really problematic. But it's an area that we'd happily come on and we'd do another webinar with me and John to really help you explain and for the guys to listen to about what are the problems.
Yeah, no, that's really helpful. And I guess going back to what we talked about earlier, it's the importance of having the power team, the right professionals in place, the right solicitor who knows what they're talking about, the right accountant who understands the different tax laws or around incorporation and how you're managing your portfolio, and obviously a good advisor, a mortgage advisor that can help you with these things. There are plenty of good advisors who understand this stuff, but also there are plenty of advisors who they're out of their depth in the specialist space, and that's fine. It's just making sure you do get solid advice. Okay, great. Well, look, I think we've covered a fair amount there, and I know I'm very conscious of taking up too much of your time because I know you're a very busy man. So thank you very much for coming on. Really appreciate it. Before you shoot off, we like to get sort of 3 top tips for people from an investing or any finance tips that you may have. Have you got any you can share with us?
Yeah, my top tip would be look for new build properties or newish, because if you work out the cost of maintaining a newer property compared to an older property, in my opinion, will work out a better strategic investment. Secondly, have at least seen a good tax advisor once to understand that your structure of ownership and what you are offsetting in your tax, you're maximising your allowances. Thirdly, and the most important tip I can give you is make sure that when it comes to mortgage advice, you only deal with Gareth Morgan, because what Gareth has done is invested a lifetime in his business and his integrity and his workload. And it's people like Gareth that make such a difference. Is you will always, as a landlord, need an advisor. They get paid by the lender, but the value they will bring you and your bottom line is invaluable. So in my opinion, the best tip I can give you is to make sure you keep a relationship with Gareth Morgan and value that relationship.
Thank you, Roger. I wasn't expecting that third one. So I promise I didn't pay you to say that. So no, really valuable, Roger. I've known you for a long time. And whenever we've had conversations and I've seen you present on it over the years, and you've always sort of wowed the audience with your depth of knowledge and your ability to share and turn complicated ideas into simpler ones as well. So hopefully we've managed to do that today. And for any listeners that would like to reach out or connect to you, what's the best way for them to connect with you?
So you can contact me on LinkedIn. I'm on LinkedIn at Roger Morris there. The one thing I've got to say is we don't deal with landlords direct. We always use a mortgage advisor. And I can't talk to landlords about tax advice. So it's kind of more, it's one of those points, well, what's the point of you, Roger? My point is to support Gareth. So, which is why we do these events. We can do it that way. But if you do want to contact me, I am on LinkedIn.
Yeah, and I would suggest that people do follow, if you are on LinkedIn, to follow Roger, because you'll see what Roger's getting up to. He's always busy and speaking to other people and sharing his knowledge as he has done today. So Roger, thank you very much for your time. I really appreciate it, and it's been great having you. Hopefully we'll catch up again soon.
Thank you.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.